bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the November 4th, 2025 episode. In many states, we're having elections today, but that's not the focus of this week's podcast. My guests this week are Kevin Wilson, as you can see on the screen. He's a partner in Novogradac's Walnut Creek, California office, and Peter Lawrence, Novogradac's Chief Public Policy Officer. And Peter, of course, is based in Washington, D.C. Kevin and Peter are on the podcast today to discuss a proposed tax incentive that would help nonprofits raise capital from individual investors to rehabilitate and preserve affordable rental housing. Now, the foundation of this new tax incentive that's being proposed is to allow individuals to deduct tax losses from the operation of renovated, rent and income restricted, affordable residential rental housing that's managed by nonprofits. Now, there's a lot embedded in what I just said, and rather than me lay the groundwork, I want to bring in our guests. We have a lot to discuss today, so if you're ready, let's get started. Peter and Kevin, welcome back to Tax Credit Tuesday.
Thanks, Mike. Always appreciate it.
Thanks, Mike. Happy to be back.
So Kevin, we'll start with you. This is your third appearance on Tax Credit Tuesday, but it has been more than a year since you were last here. Hopefully it won't be a year until you're back on after this podcast. But with that background, please share with our audience some of the services you provide to Novogradac clients.
Great. Yeah, I'm happy to be back. I'm happy to be talking about something new as well. I think in my previous visits, we were exploring some year 15 LIHTC issues. But so as Mike mentioned, I'm an accountant in our Walnut Creek, California office, and I provide a variety of accounting services, audit, tax, a variety of consulting services with a substantial portion of my efforts focused on affordable housing, LIHTC, and opportunity zones.
And then hopefully in the not too distant future with the residential rental housing preservation incentive that we're going to talk about.
Absolutely.
Now, Peter, this is your 23rd time that you've been a guest, which you're probably wondering how that compares to Tony Capone. And Tony Capone obviously is a guest on our Renewable Energy Finance series and also a co-host at times. So you're second only to him, and that's a good person to be second to. But even though you've been a guest many times, I'd like you to take a moment to remind our listeners and to tell any new listeners of the various services you provide to Novogradac clients.
Thanks, Mike. Of course, we in the public policy department are always available for public policy related engagements. If you have a problem with engaging on a particular program or guidance that's not helping you finance your property or investment, we're here to help on those type of engagements. And we also function as a policy advisor to the various working groups, including the one that Kevin heads that we'll be talking about later on in the podcast. But each of those working groups, including the Low-Income Housing Tax Credit Working Group, the New Markets Tax Credit Working Group, the Opportunity Zone Working Group, and others, meets monthly to get an update on what's happening in DC and on key federal legislative and regulatory policy issues. And I help provide those updates and help coordinate the firm's public policy efforts in powers restrictions, so in the practice areas. So really appreciate the opportunity to be here.
Great. Thank you for that, Peter. And thank you for all the great work that you do. So Kevin, before we talk about the actual incentive itself, and as a tax accountant since 1984, me jumping in, I tend to want to jump right into the tax incentive and all the intricacies as to how it works. But let's foundationally discuss the need for the three of us and most of our audience having to discuss the need for an incentive like this might be a bit redundant, but just to ensure that we level set, if you could share a bit about we are supportive of this incentive based upon the needs that we all see out there in the cities and towns in which we work.
I mean, I think it's pretty well documented that there continues to be a growing demand for the need for affordable housing. And we have some fantastic tools at our disposal to help. But at the same time, there are some factors at play that are putting downward pressure on the supply or the quality of some of this housing, right? So, there's some great reports out there that show how some of this housing that's been around for many years is at risk of losing affordability for a variety of reasons, either the use restrictions that were enacted many years ago are going to be expiring soon, or the housing is just, it's been depreciated, right? And it needs some renovation. So it's at risk of physical needs. Uh, but so the idea here is to fill that gap. But there's this, I really like the hole in the bucket analogy, right? So a lot of these tools that we have at our disposal now, the tax credit being one of the key pieces, and the states are generally providing that a lot of these credits are going to building new housing, adding to the supply. But then some of these older properties that might be at the end of their restricted use period, it's like there's a hole in the bucket. So they're falling out of the supply here of affordable housing. So the idea here is to try to find a way to plug the hole in that bucket with a new incentive, right?
So I do like that analogy as well. There's a hole in the bucket, and I won't go down. There's a hole in the bucket with what shall I fix it? Peter's kind of smiling. He's like, no, don't start, Mike.
Hey, put some numbers on this, Mike, for you.
Please do.
Yeah. So according to the Public and Affordable Housing Research Corporation, they put in their picture of housing preservation report that in 2024, we financed roughly 100,000 new affordable rental homes, which is great. And the low-income housing tax credit is a very key resource for that. But we lost about 71,000. So we only got a net gain of around 30,000 units. And given their estimates range, right, what we need, anywhere from 3 to 7 million affordable rental homes that we need in the country. And so while the very welcome expansion of low-income housing tax credit is going to help get some of that need, and we do anticipate some more resources going into preservation from that expansion of low-income housing tax credit. The needs are so great that it even outstrips what the newly expanded housing credit can do. And so we need more tools out there to solve all these various problems we have. And we think this proposed preservation tax incentive would be an excellent new addition to that toolkit.
So Kevin, you sort of highlighted how, and thank you for that, Peter. And Kevin, you highlighted how there is this need for renovation dollars. A lot of properties, they've been in service for 15, 20 plus years, and there is a need for renovation funds, as well as a need to ensure that they're preserved as affordable housing and don't go to market rate, don't have the rental restrictions expire.
Right.
And there's a effort now with this new proposal to create this incentive for renovation and preservation. But it's also sort of unique in that it's focused on individuals. And I did write an article a couple months ago in the Journal of Tax Credits on the broader need to open up various tax credits to individual investors. And depending on the tax credit, there's certain changes that would need to be put in place to allow it to be opened up to individual investors versus corporate investors. This provision is specifically targeted at individual investors. And please explain for our audience what the central change in tax law that's needed in order to create this window for individual investors to invest in residential rental housing.
Right. So the low-income housing tax credit was created back in 1986, right? With the Tax Reform Act of 1986. Another key change that was implemented back then was Internal Revenue Code Section 469 implemented some limitations on individual taxpayers to use losses from activities that they weren't actively engaged in to offset their taxable income. So the idea here would be to create a narrow exception to those rules for investments that are directed towards the renovation and preservation of this affordable housing that's managed by nonprofit affordable housing developers. So another kind of key piece here is a lot of these properties are owned and managed by nonprofit affordable housing developers. And since those entities are exempt from taxes, the properties are still generating these losses, but absent a tax-paying partner in the deal, that they're not being monetized, right? So they're not generating value that can be reinvested in improving the property.
Great. Thank you for that. And many of our audience will know that what you're referring to are the passive activity limitation rules. And sometimes they're called the passive loss rules. And as a tax accountant, I call them the passive activity rules because they limit the ability to claim both tax losses and tax credits. And as you appropriately pointed out, they were enacted back in 1986. And I will note that the enactment back in 1986 did provide a narrow exception for a number of years for losses for a certain type of residential rental activity, and that was affordable rental housing. So there was this initial transition rule that gave favorable treatment to losses from affordable rental activity. And then many listeners also know, and viewers know that, back with the 86 Act, they did create a narrow exception for low-income housing tax credits, but it is a very small exception. An individual can't claim much in the way of low-income housing tax credits under this narrow exception as a general rule. And as a consequence, the market, while initially was individual investors, as equity prices rose and corporate investors started entering the market, the individual investor market in low-income housing tax credit essentially vanished. So they've had these passive activity limitation rules in place since 86 that really limits the ability of individuals to invest in rental activities and getting any tax benefits on a current basis. I will note that in 1993, the rules were expanded. If you're a real estate professional, these rules for residential rental activity losses. And there was a certain New York City developer that was active in lobbying on behalf of this expansion. And now that New York City developer is now president of the United States. So Trump has a history with carving out exceptions within these passive activity rules. So foundational to this tax incentive is that individual investors could invest in properties that met the various requirements of being affordable, rent restricted, income restricted, and then they could deduct those losses against other income. And I'll note that it's also, as we've talked about, as this provision was being designed, that opening up the market of investing in affordable rental housing to individuals is a way of getting additional capital and not straining the capital needs and going back to corporations, expecting them to be investing ever more in this other area. So with respect to that, in addition to the passive activity, which is a limitation exception, narrowly, as you pointed out, being foundational to this tax incentive, please describe some of the other features that would be layered in order to create a product that we think many individuals who are socially minded and want to get a reasonable yield on their investment would need to have, such that there's these additional provisions that we would layer in.
Yeah. Yeah. I mean, so as we were exploring this concept initially, we looked at some case studies. Obviously, freeing up these losses with that narrow exception to the passive activity loss rules provides a tremendous opportunity. But in many cases, that in and of itself wasn't significant enough to kind of make this incentive work. So for example, while the investor realizes these losses throughout this kind of new compliance period, those losses are going to bring their capital account to zero and then even below zero. And then what that does is that creates this issue where they get down below zero when they exit the deal. stepping them up from below zero up to zero creates a potential for taxable income. And so one of the ideas here is to create an exception so that that income would not be taxable. And that's somewhat similar to the 10-year hold benefit that we see on the opportunity zone incentive, where capital gains that are realized after a certain period of time would not be taxable. That's a very helpful feature here. In addition to that, there is an idea to allow for the immediate expensing of renovation costs. So those losses can be realized immediately to the extent that they're going into qualified property. And then also allow for accelerated depreciation of the acquisition of the building. Typically, it's depreciated over 30 years, cut that in half to 15 years. So those are a couple of the key pieces there.
Great. Thank you for that. I mean, just to summarize, 3 key additional benefits. And in preparing for the podcast, Peter also reminded us that when this proposal was originally being designed, there was a 4th feature. And the 4th feature was full expensing of personal property and land improvements. That's because as the proposal was being designed, the ability to expense land improvements of personal property was phasing out. Anyone who's a regular listener of this podcast knows by now that the One Big Beautiful Bill Act did make the expensing of personal property and land improvements a permanent part of the tax code. So that 4th feature didn't need to be included. So now the concept is to, 1, allow expensing of renovation costs to incentivize the renovation. 2nd, let the building be depreciated over 15 years instead of 30. And we'll note that 15 years trails back to the pre-86 Act, where there was a 15-year depreciable life. So that's a bit of a back to the future, if you will. And then, as you noted, Kevin, the 3rd is no recapture of losses when you exit the property if you stay in the property for 10 years. And if you didn't stay in the property for the full 10-year period, you wouldn't get that exception. So it's going to so the idea is to create this patient capital over the 10-year period. Anything else, Peter, that you wanted to say about the 3 sort of core technical pieces, or anything else that we haven't covered yet before we move on?
No, I think that's the key issues. I mean, there are some other tax code amendments included in the proposal, but those are the key ones that I think are worth noting. I guess I want to just reemphasize one point you made earlier, Mike, and that is the design feature of it targeting individual investors is really key to not only are we not competing with the local housing tax credit, it is a complementary tool for the preservation activity. They're both tools we expect to be used for preservation. Having it targeted to individuals also makes it not in competition with the local housing tax credit, given that it is primarily targeted to corporate investors, along with the other vault tax credits like new markets tax credits, historic tax credits, and the clean energy tax incentives. So by targeting that relatively undertapped base of individual investors, that helps, I think, set this proposal apart from the rest of the tree development financing toolkit.
I'm glad you
There's some
mentioned the
additional
other
value there
Kevin?
there's some additional value here on the individual side too, just because individuals are in this context are generally taxed at a much higher rate than the corporate investors.
No, yeah, the corporate rate being 21% versus individuals being a top rate of 37%. Individuals have a greater can value tax losses at a much greater rate. Not to say that individuals wouldn't prefer a 21% tax rate or that corporations want a higher tax rate to get more benefits. But given the layout of the tax code, the 37% definitely, that sort of top rate creates greater value of tax losses to individuals than for corporations. And I appreciate, Peter, you mentioned the other sort of tax incentives because, one of the themes that we have on the podcast periodically is the notion of twinning versus sidecars. Twinning being layering the same benefits through, so they're all flowing to the same investor, the other being like a sidecar investment. And this incentive is intended to be a sidecar to affordable rental housing preservation, to the long-term tax credits, in the sense that you do one or the other, you can't do both. So this is not to eliminate the passive activity rules for long-term tax credits. That can be left for another discussion and other articles that I've written about in the past. This is really focused on non-tax credit, affordable rental preservation transactions with a notable renovation. So Peter, tell us, we've discussed this concept now. Tell us where we are from a legislative perspective. We've done a lot of work with a number of folks to try to help develop the concept. And then obviously we got to get the concept to be more than just a concept. So tell us where we are.
Yeah, so we've been working with members of Congress to introduce this proposal as tax legislation. I think maybe also be useful, Mike, just to mention a few of the eligibility. We've talked a lot about the structure of the tax incentives, but what's the universe we're looking at here? We're looking at 15-year property, at least rental property that was constructed 15 years ago. You have to expend at least $20,000 a unit or 20% of your basis on renovation costs. You're targeting low-income households, those earning 80% of the area median income or less, and you're required to maintain property for a minimum of 20 years affordable post renovation. So some of those key eligibility features of the proposal. We are fortunate to have Representative Mike Carey, who's from the 15th District of Ohio, key member of the Ways and Means Committee, which oversees tax policy. He's agreed to champion the proposal. The federal government shutdown, which is for another podcast perhaps, has also been a bit of a challenge, obviously slowing things down and preventing us. I think we had made progress and we were close to having the legislation introduced before the shutdown, but the shutdown kind of is not enabling us to go forward. And hopefully the federal government will be reopening in sometime in the near future. And once that happens, I think we can continue re-engage Representative Carey to get the legislation introduced. And once we do, we'll turn to get companion legislation introduced in the Senate as well. And once you have those bills introduced, Mike, we're going to try to rally the affordable housing community to support. I think we've got a good list of endorsers of the proposal that we've established, led, of course, by the National Community Renaissance, which is a major national nonprofit developer, amongst many other groups that focus on preservation. Trade associations like Stewards of Affordable Housing for the Future and others have also endorsed the proposal. And we will, of course, do the blocking and tackling of trying to get co-sponsors and support for that legislation so that we are ready whenever there is an opportunity for major tax legislation, because that's always the case that individual tax bills rarely move on their own. They typically are packaged with broader tax legislation and move together. And, those opportunities can pop up unexpectedly. We mentioned opportunity zones. I think, that was originally introduced as the Investing in Opportunity Act. And I don't think many people, when that bill was introduced, would have thought that tax reform would have been the vehicle in 2017 to get that enacted, but it did. And so we want to be ready for opportunities like that when they develop in the future.
Thank you, Peter. Now, Kevin and Peter, maybe you can share with our audience the work that you've been doing with the Rental Housing Preservation Working Group, which is a working group designed to provide support to this provision in a variety of ways. And once again, anyone who's listened to this podcast more than once knows that we have a series of working groups. We have a long-term housing tax credit working group that focuses on pressing issues, concerns, opportunities with the long-term housing tax credit, one for the new markets tax credit, one for opportunity zones, one for renewable energy, one for income limits for LIHTC and other properties, And now, Kevin, you're leading the Rental Housing Preservation Working Group. So please share with our audience more as to how the first meeting went and
Sure.
what your plans are for the group. And then obviously Peter Wayne as well, because you're both integral to the success of that working group.
Yeah. So the newest of these working groups is the Rental Housing Preservation Working Group. We held our first meeting about a month ago, right? And we're going to start meeting every month. And we were very pleased to see pretty significant interest. I think we had over 100 join us for that first call. And, we're welcoming new members who are interested in joining, just so you can kind of stay on top of what's happening and be better prepared for both emerging opportunities as well as potential threats, and just learn from others who are kind of going through the same thing that you're going through. And just, it provides a platform for you to have a voice as we go through the legislative process. And once we get through the legislative process, surely there's going to be a regulatory phase that we're going to be very close to the action on. So,
And Mike, I'll just add, we expect, the legislation as introduced, we expect there to be changes, and the working group is going to be there to help advise the proposal champions in Congress how to make those changes as the, legislation is considered. And so if you want to be in sort of the core group helping shape the legislation, shape the proposal, that's the best place to be to get all those details and be a part of that, starting a whole new financing tool for water housing.
No, it is interesting to draw parallels to other working groups, because the New Market Tax Credit Working Group was sort of started in large measure to help understand how the New Market Tax Credit could be used to raise equity capital for distressed businesses in low-income communities, and working through some of the structural and other sorts of issues, and having a large enough group to be brainstorming, if you will, in those early days before there'd even been an allocation yet and the rest. And then similarly with the Opportunity Zones Working Group, where we were thinking through how that incentive could be used, how it should be structured, what were the better use cases and things of that nature. Now we have the Neighborhood Homes Tax Credit Working Group, or we've been spending a lot of time there. We haven't that bill that hasn't been enacted yet, but providing a lot of support there. So we just welcome audience members to join this Rental Housing Preservation Working Group and help us think through the ways in which it could be used.
Neighborhood homes, that's a great example too. I mean, that's been introduced a couple times, and this most recent introduction had some refinements and enhancements over the previous version.
Exactly. So we've talked about why the incentive is needed, and we've talked about some of the ways in which the incentive would work. Peter shared with us where we are in the process of getting legislation introduced, but us to be introduced before it can be enacted. And we've talked about the working group that you and Peter are leading. So Kevin, what else do you want to share with our audience before we bring this podcast to a close?
Well, again, we're really trying to promote awareness and build support for this new incentive. We're going to be in Las Vegas in about a month. We're hosting a housing credit finance conference, and I'll be moderating a panel at that conference that further explores preservation and the HOPE Act in particular.
Great.
We'd be happy to have more of you out there with us.
Yes, I believe that's Thursday, December 4th and Friday, December 5th. So it's a day and a half. And then on the Wednesday before, we have a number of other sessions. I'd also note that on that Wednesday, December 3rd, we're also holding our Opportunity Zone Summit. So there's lots of opportunity for those involved in rental housing to join us for the Opportunity Zone Summit and or the Locals Attachment Conference. And as you mentioned, there'll be this as one of the sessions. So there'll be lots there for our audience to learn. Peter, any additional thoughts?
Yeah, I just want to encourage folks to reach out and join the working group, join the efforts to push this proposal forward, to get support for as many key members of the Ways and Means and Senate Finance Committee once the bill is introduced. And if you're interested in learning more about advocacy, please feel free to reach out to me directly, and I'm more than happy to help you advocate for this resource.
Great. Thank you very much, Peter. And thank you, Kevin. There's a lot more details that we could have covered in today's episode. And I know that we'll be going into a lot more detail of this proposal in the various monthly working group meetings, like reviewing models and things of that nature, so that those who are members of the working group get a more direct understanding of how the incentive would work, and they can start planning for it, as well as commenting on additional ways in which the incentive could be further and better refined to make it even more effective. We'll certainly be talking about the proposal on this podcast in the weeks and months ahead. To our audience, I will include Kevin and Peter's contact information to show up in today's show notes. I encourage you to reach out to Kevin Wilson and to Peter Lawrence with any questions you might have. I will provide a link to the working group page in today's show notes, as well as to our Las Vegas conference. I'll also include a link to the article that I mentioned on expanding various tax incentives to more individuals, something that I wrote a few months ago. I would encourage our audience, or I do encourage our audience, to stick around for our off mic section, but I wanted to first remind all of our audience members to subscribe to Tax Credit Tuesday on whichever platform you get your podcasts. And if there's a platform you have that we're not on, please let us know. Just email cpas@novogradac.com or email me directly so that we can get on that other platform. If you're watching on YouTube, please take a moment to like and comment on the video. That helps raise our visibility and increases the chances others will be able to find the podcast more readily. And as I say every week, please do share the podcast with your colleagues. It's a great way for someone new to these various incentives to get started, as well as for those who are more experienced to keep abreast of new developments in some of the many areas that we cover, as well as learn about new incentives, such as the incentive we're talking about and spoke about here today. And with that, let me turn to our off mic section. This is always a fun place to give a shout out to others working in the tax credit and tax incentive communities, an opportunity to highlight an individual who deserves and has earned recognition. And there's never enough recognition in this world for positive deeds, or you certainly can't have too much recognition for positive deeds. So in terms of shout outs, we're going to get two this week, one from Kevin and one from Peter. So Kevin, let me start with you. Who would you like to give a shout out to?
I'd like to give a shout out to Lorraine Indrid and her colleagues at National Community Renaissance, or National Core. So they're a large nonprofit developer that's really been leading the charge behind this incentive for preservation. And Lorraine will be joining us at the Vegas conference on my panel to discuss preservation.
Great. Thank you for that, Kevin. Let me echo that shout out. Lorraine Kendra is a very effective advocate for support for affordable rural housing, and the expertise she and her colleagues at National Core and their other service providers have provided for the incentive here has been very much above and well beyond the call of any duty here. So my thanks as well to Lorraine and everyone at National Core. Peter, how about your shout out?
Well, Mike, as you might guess, given I am a public policy guy dealing with Congress, I would like to give a shout out to the lead champion on the Hill, Representative Mike Carey, and his tax staff, Michael Lundquist, who are leading the charge for this bill. And we expect to lead the introduction when the federal government reopens, hopefully soon, because this shutdown has been going on for a very long period of time. And I'll just also note, by the way, as a happy coincidence, Representative Carey is also keynoting our renewable energy conference this week here in Washington, D.C. And for those of you who are interested in renewable energy, it's not too late to register and attend for that either. And perhaps, Mike, you can add that in your shout notes as well. We're very much looking forward to Representative Carey's remarks at the conference. And he's really a great champion, not just for renewable energy, but he's got a lot of proposals on housing, community development. He's a big advocate for historic preservation, affordable housing. He's got a couple of bills. So we are really fortunate to have someone like that in Congress advocating for these type of proposals.
Great. Thank you for that, Peter. I echo this shout out as well to Congressman Mike Carey. He's a great advocate for the role of tax incentives in terms of driving community investment, driving the investment in affordable housing and green energy and the like. So I really appreciate that he's agreed to be a champion for this proposal as well as a number of other proposals, and really excited that he'll be joining us at our Renewable Energy Tax Credit Conference this Thursday. And we are recording this on Tuesday, November 4th. Oftentimes we record the podcast early, but we are recording it on Tuesday, November 4th. So hopefully it posts today. It might actually post on the 5th, depending on processing time and such back in California, because I myself am in Washington, D.C. for our conference. And with that, let me say thank you again, Kevin Wilson in our Walnut Creek office and Peter Lawrence in our DC office. And to our audience, Michael Novogradac, thanks for joining us today.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.